Chasing hot stocks feels like gambling, but what if there was a smarter way to play it with 90% less risk? Let's dive in with Nick to show you exactly how to stay in the game. I again have the great pleasure of being joined by Nick Galarnik to talk some options and these markets. How you doing, buddy?
Doing great. The market's been very, very good to me, and summer's beautiful. How about yourself?
Oh, everything's great. So let's talk. First, I want to get your opinion on these markets. The market's been running hot since that April low, and just a handful of stocks have been really driving this move. How do you size this all up? Let's talk about it and talk about opportunities of how to trade this.
We're looking at seasonality right now in the markets. So typically, July, I mentioned previously, is very, very bullish month. Thus far, we've seen that as well. We're at all-time highs on S&P and Nasdaq, but these gains have been driven largely by the mega caps. Nvidia, for example, like today, right now, the market is pretty much flat, but Nvidia is up right now 4.5%.
Yeah,
Google's up about 1%. The point being that the mega caps are carrying the weight of this market. It's not heavy breadth overall. And the reason why we're seeing these rallies is because of the passive flows of investments typically made in July right now. Like over the past 20 years, July's been a very, very green month. So right now, I'm a bit concerned about positioning because we haven't really resolved the underlying issues of tariffs, and the Fed doesn't seem to be cutting this month, nor will they probably be cutting in August either, because inflation is still alive and well. And so the idea here is that you want to be cautiously optimistic. You want to protect your gains as well, because the asymmetry risk is not very good where we are right now. Like
it's
we're
not.
very high on a number of metrics across the market. Historical PEs, Schiller PE, even price to revenue growth as well. Not very good overall. But that being said, most people want to keep on maintaining that upside in their portfolios without having the downside risk. So how do you
Absolutely.
how do you
Well,
you know
how do you implement that? That's the key because look, if the market stays hot for another 2, 3 weeks and keeps going, people want to be in, they want to participate. The thing is that you going and buying a laggard like Adobe and that hasn't been able to get off the mat is not going to play catch up over the next 3 weeks. That money is flowing and it's flowing and it's chasing a very small number of stocks and is hurting all these investors into a very narrow group. So if you want to participate on the upside of these stocks, you have to ask yourself, how do you do it? Now, the obvious and most common thing to do is just buy the shares. Oh, I'll just put a trailing stop loss behind this thing and I'm just going to ride the stocks hot. So people just buy the shares outright, ride this momentum, and inevitably get stopped out. What are the issues though with this? And to me, the issue is as well, you have gap risks. You have the momentum of the stock means that you have a huge capital outlay on it. And the question is, how much relative return do you have until we inevitably hit some sort of a short-term high and a reversal? And this is where using option strategies is such an amazing tool. So let's just give a basic profile. Okay, let's even right now, if NVIDIA just did a mean reversion back to its 50-day moving average, which if you look at its chart for the last 5 years, has repetitively gone back to retest its 50-day moving average. Well, right now, we're talking about a $25 pullback just to go retest the moving average. We're not talking bear
yeah
market, no decline. Now, in order for NVIDIA to make $25, we're talking about it making a punch towards 200,
yeah
right? So at this stage, I look at it that your asymmetry is at best equal. You have a 25 upside for a 25 downside, which you're trying to manage your risk through stop losses and other ways. I want to talk an option strategy or two about how to potentially continue to profit from the upside of NVIDIA, but to change that payoff profile considerably from what a stock investor would get. So I know you have an idea you want to share, but I want to start off with mine. I'm going to
sure
start off with just the most basic bull call spread. So let's start off here. First of all, let's put up a chart And what you can observe here is NVIDIA's had this beautiful run. We're now talking about that asymmetry, that it has a $25 downside risk to the 50-day moving average and about a $25 upside potential to about 200, right? And so this is about an equal payoff profile on from that perspective in terms of the risk to return ratio. Now, I want to talk about a simple thing of like, well, look, what if I just for the next month, because look, it only took 3 months for the stock to go from 90 to 170. If it's
Yeah,
going to go, if it's going to go to $190, you don't need a 3 month strategy. It's either going to 190 or it's not, and it's going to happen soon. So, to me, I don't think you need a strategy longer than 1 month if you are riding momentum. And so this is
correct.
where I wanted to simply price out a bull call spread. What I have here is the August 180 to 190. So the 180 call option is giving you the right to buy the stock at 180. The 190 is giving you the
Obligation.
obligation to
Yeah.
sell, and therefore you have a $10 wide spread. It's called spread. You're trying to profit from the $10. Right now, to outlay this is just slightly over $2.
Mhm.
To buy it. So now instead of you buying, $17,000 of stock with 100 shares, you literally only have to outlay $200 to have that upside spread that can pay off $10, the $10 wide for a $2 cost. So basically a 4-to-1 payoff
Mhm.
in doing this. To me, this is attractive, and what makes it particularly attractive is that Nvidia's earnings are all the way out at the end of August. So right now, the earnings, the volatility premium in the August month to the 15th expiration is very cheap.
Very cheap.
35% implied on Nvidia at a time when this thing is running hot, right? You don't have to pay all that earnings vol premium
Yeah.
that is being priced in there. So to me, you have a very small capital outlay, continue to participate on the upside of the stock, and if you're wrong, you can't lose more than $200. Now, I know I told you the strategy, and you said you had a better idea, or at least an interesting other approach to this. So, what idea do you have in terms of how we can approach putting on an Nvidia long?
So when I look at each like strategy that's given to me in terms of like the positioning, any given thesis, I analyze from numerous perspectives. The first thing I usually do is look at the straddle price to determine what the implied move is by a certain expiration date. So, like for example, right now, the August 15th OPEX, the implied move there is about roughly $15 in one direction. So
Right.
the upside there from the current price is about 185, downside's about 155. So, and understanding that seasonally as well, after July, we enter this window where, historically speaking, August and September are the worst performing months in the market historically. So that's a very, very weak lead up to the NVIDIA earning report, which should be probably very, very good, especially given the news today where China is apparently now allowed to purchase their chips again, their high-end chips, which is going to open the market back up to them again, which they previously said the earnings would perhaps drag it down by, I think it was like something like $8 billion, roughly. Don't quote me on that. I can't remember the exact figure, but it was around that number. And so right now, it looks very, very good overall on a setup into the earning report. So um, looking at that 185 target upside range, that 180 190 spread captures it, greatly. But what if you could reduce your risk even more and keep your upside as well? I think using a not a normal butterfly, but a broken wing butterfly makes sense. And the reason
Okay.
why I think it makes sense is because, first of all, I'll describe what that is. So in this case, you mentioned buy the 180 strike call option, sell the 190 strike call option against it for a straight call spread. But what you could do instead is layer on a second short contract at the 190 strike, and then you can buy the 195 strike. Now, this creates an uneven butterfly where you have a call spread 180 to 190, debit spread, and then you have a credit spread from 190 to 195. Now, that removes the risk from about 220 down to about 160. So a reduction in risk of about 25% of your outlay. Now, you might say, Nick, it's not very consequential overall, but the key thing here is that the probability of us overshooting to that 190 area is not very high, especially given the moves today. In all likelihood, it will probably pull back down to 160-ish, perhaps before the earning report, in
Yeah.
which case it's a losing proposition. So the idea here is that if you want to maintain upside in NVIDIA, it's better to do so in an asymmetric way, not to, for example, hang on to the stock and or hang on to your leaps, perhaps, because right now you can keep upside with a very, very small outlay. Whereas, where if it pops, $15, you're making 2 to 3x return, perhaps even 4x return on your money. Obviously, if it hits max profit at 190, you're making a return of about 8 times your money, roughly, right? Which is fantastic. And if it overshoots and goes to $200 per share by August 15th, you still win. You win about 2.5 times your money overall, right? So it's a very, very strategic way of placing a bet on a thesis in a shorter duration time frame, right? Versus if you're long term NVIDIA, you're holding it in your Roth IRA or your 401k, and you don't want to touch it at all. I understand that. The play might be there instead to sell covered calls for the August OPEX, perhaps, or maybe even just after that, capture some of that premium by pulling in some income in your portfolio and reducing your cost basis while capping your upside temporarily. But if you're not, or if you're long it and your current asymmetry risk is not very good, that being you're risking, for example, 17K on 100 shares right now. If it drops to 160, you're down $1,000, right?
Yeah.
If you buy one of these positions, you're risking $160 for upside of $840. That's not bad at all. Granted, it has to move $10 plus to the upside to hit that area. But the whole idea here is that you're expressing asymmetry of risk by taking a small position of risk with far greater upside versus keeping on significant risk of 170. Like, for example, if I were to ask the audience here, would you guys want to buy NVIDIA right now at 170 after a run of $20 in the last couple of weeks? The answer is probably an unequivocal no, because even though long term the prospects are very, very great, it's a $4 trillion plus company right now. It's almost 1/10 the value of the entire US stock market, which is kind of crazy when you think about it, right? For one company. But that being said, they are a powerhouse, and this news today is obviously very bullish, but you want to be very cautious as we enter that pocket of August, September, where historically speaking, the markets are not very, very favorable to the bulls.
Right. So listen, Nick, I absolutely love that explanation. It's a great way to put it. What it really comes down to is this. Options are not the simplest thing, because obviously just buying a stock outright and then selling it is actually the most straightforward way that most people approach things. But those people that are willing to learn a little bit extra in terms of how options work and behave have a whole universe of strategies at their disposal that allow them to continue to participate on things and be able to manage risk, define all the parameters of your trade, be able to generate income on your stocks, do all sorts of different things that are not available to you if you're a stock only investor. This is why you want to learn about options on that. So thanks, Nick, for sharing that. If you guys want to learn about Nick's programs, click on the link in the descriptions below. Nick, thanks for joining me, buddy. And we'll catch you next time. Cheers.
My pleasure, guys. Take care.